Hello everyone and welcome back to another video. Today we're going to be looking at a quite frequently requested stock here on the channel, which goes by the name of Pinduoduo. Now, PDD stock, which is traded on the Nasdaq, has been one of the best performing China stocks of the past 12 to 18 months, gaining over 250% since the start of 2020. However, very recently it's run into some issues, more in line with growth stocks in general and more specifically China-based companies, but it's lost around 35% of its value from its high. But putting all the noise to one side, our aim here today is going to be to determine if Pinduoduo presents a good investment opportunity for us today. And to do that, we will be reviewing Pinduoduo's business and its business model, do our best to understand the business and see if it has a sustainable business model. We'll analyze the past performance of the company and its current financials. Then we'll look at Pinduoduo's potential for growth and its addressable market, see what maybe sort of a pinnacle would be for this company, how big it could get and how quickly it could reach that pinnacle. And then at the end, do a quick valuation, do our best to set a fair value range for PDD stock. And so what is Pinduoduo? Their name, I feel, contextualizes the business and the strategy quite well. So Pin stands for together, then Duo stands for more. More savings, more fun. Whilst using the platform, you get the combination of both and you can do it together. Of course, they are an e-commerce platform. If you didn't know that already, it's actually one of the largest in the world by GMV and monthly active users. But we'll look at that in a bit more detail in a second because it's quite a controversial topic for this company. But firstly, I want to cover the business model, how they're unique to the other rival e-commerce platforms such as Alibaba and JD.com, because there's a bit more complexity with this one, at least in the way that it's set up and its unique selling point. And they approach it in a very different way, and by essentially making it more of a social commerce platform rather than traditional e-commerce. So buyers or users of the platform are able to access it through their device, mostly through their mobile app, and it all stems from Tencent's WeChat or QQ app. That's where most of the traffic comes from. And by the way, Tencent owns a significant stake in this company, which is very interesting. Buyers are given recommendations for products that suit their profile and essentially are given the parallel to the shopping mall experience from their phone, or so Pinduoduo say they do. Buyers can also search and find products that they wish to purchase themselves, and they will be given two price options for this. The price to buy it individually by themselves, and also the price to buy the product as a group. And that's where the group purchase comes into it. This is at a lower cost, a significantly lower cost as well. And it's important to note that the majority of sales and GMV comes from this group purchasing. And also the majority of products are agricultural products or agriculturally based products, which means they're everyday items, food items, relatively low cost to the consumer. This probably wouldn't work on high-end luxury items anyway. And to purchase as a group, what they need to do is they either need to find an existing group or share the sale via social media platforms like WeChat to create a new group purchase. And this has been instrumental in growing the platform as of today, up to today's date, but has also meant the majority of sales have been subsidized. And that's because Pinduoduo subsidizes or essentially creates the discount off of their own back. The merchants or manufacturers aren't cutting their prices. It is contributions given to the group by Pinduoduo. And I guess everyone can see the reason why. It's to drive traffic onto the platform, get people using the platform. We can see the target customers tend to be customers in rural areas, i.e. tier 3 and tier 4 cities in China, where the demand for low-priced everyday goods is very high relative to some of the higher earning cities or tier 1 cities. And also internet and e-commerce penetration is relatively low in those areas. So they feel this is the business model to get everyone onto a platform. The only issue I see here is that these customers are going to be price sensitive. They're going to be, at least for now, price sensitive, and any change in PDD's subsidies could affect the growth of the platform and the GMV number overall. So that's just something to consider with the business model. Now, where does Pinduoduo actually make money in this then? Because it's a very low-cost platform. They're subsidizing sales as well, so it must be very costly for them. And they're getting paid on the merchant side or on the seller side of things. So the merchants or sellers don't pay any platform fees, so they don't pay anything subscription-wise or upfront for being on the platform, but they do get charged a transaction fee, which is only 0.6% of every transaction. But the majority of revenue for Pinduoduo is coming from marketplace services, which is essentially advertising and promotional selling for merchants. They're paying Pinduoduo to promote their product on the platform. And this business model has undoubtedly been a success for Pinduoduo at the moment. We can see 66% GMV growth year over year, revenues up 97% year over year at the end of 2020, active buyers 35%, total orders up 94%. But at what cost? And that's what we're going to look at here. There are some things that are quite controversial about this company and ways in which they report their numbers or actually achieve their numbers. The first thing I want to look at is the GMV. We can see GMV growth, like I just covered, has been very good, 66% up year over year. They're now close to 1.7 trillion in GMV on the platform, which makes this a massive marketplace. The problem I found is the way in which they report the GMV. Now, I'm going to dig deeper into this, but it's just something that I do want to disclose to you all. So, their reported GMV includes failed purchases, includes returned items, it includes product selection, which essentially means that a consumer only needs to select the product and get through to the purchase stage without actually purchasing for it to be recorded as GMV. I'm not quite sure how they get away with this, and hopefully I've misunderstood it, but this is definitely something that's controversial and maybe explains the really high number in GMV that they have currently. Now, the next thing that I want to tackle just before we get into the full results of this company is the cost structure. So we can see on the gross margin side, it looks like they have, a very profitable business, really low margin business. Cost of revenue is ranging from around, apart from the most recent quarter, it's ranging from around 19 to around 24% on the upper end. So very good gross margins. The problem comes from the sales and marketing expenses. Like I said, with the business model, they're subsidizing a lot of the sales here, a lot of the group sales, so they can attract people onto the platform and they can drive the purchase price down. If we ignore the most recent quarter, this sales and marketing expense has been anywhere from around 69% to 103% of revenue, which is just, in my opinion, not sustainable, unfortunately. So this is something that if I was going to buy this company, I would like to see dropped down, because I can appreciate, the idea behind it. I can appreciate the strategy behind it. Traffic is essentially what creates long-term value, on an e-commerce platform. We learned that from Amazon and Alibaba, but it's almost like synthetically boosting your sales. And we really don't know now at this point, if they get rid of the subsidies, whether the consumers will still be as attracted to the platform. So only time will tell with that. I just wanted to point that out to you now. But coming away from the controversial aspects and the business model, you should really appreciate, the growth in which this company has experienced. Look at that average growth rate over the past 4 years, 279% top line revenue growth rate is an average since 2017. That's something you don't see very often. And just look at that number there. They've gone from 73 million in revenues in 2016 to 9.1 billion of revenue as of the end of 2020. And on a trailing 12-month basis, they're already at around 11.5 billion. So, they're growing exponentially. They are burning some cash, as you can see. Last year, they burned around 1.1 billion, 1 billion the year before, but we've already been over that. Shares outstanding, they have been diluting shareholders as well with their business model. As we've seen, they need to spend a lot of money. They need to burn a lot of cash to generate all of these sales at the moment. So they have been raising money. The good thing, and I will say this is a good thing, they've now got 13.3 billion in cash on the balance sheet where they've raised so much money. Now, the way in which they're burning cash, this won't last too long, but it does give, investors maybe some sense of security that they won't need to dilute you again for at least a couple of years. And I think analysts, when I was looking at it, are expecting this company to be profitable, if it can be profitable, in the next 4 to 5 years. So you may see some dilution, probably not as large as we've seen in the past 3 to 4 years, though, definitely. And now this is the part of the video in which we look at what the growth drivers, potential for growth that Pinduoduo has as a company. And what I want to look at is its addressable market, the Chinese e-commerce market, which is set to grow quite rapidly as an industry over the next 5 years. This bit of research here shows it growing at around 13% compounded for the next 4 to 5 years. I've seen research that says it can continue that for around 7 to 8 years as well. So we're going to be using that in our valuation, which you'll see in a moment. The next thing I want to look at is the market share. Now, this is slightly dated with it being researched back in 2020 and 2019. So I wouldn't be surprised if Pinduoduo's market share is now a little bit higher than 7%. Alibaba's is probably a little bit lower than 56% of what you see here. But It's still interesting to see Alibaba pretty much dominates the market in terms of transaction value and GMV. JD is behind, but still by quite some way. Pinduoduo has staked, almost 7% share of the market in a relatively short time period. So that's a very good sign. And I think what's going to help them eat away market share in the future are some of these growth drivers down here. First of all, the internet penetration rate. So as of March 2020, last year, only 64% of the Chinese population had used the internet. And when you account for the fact that the Chinese population is around 1.4 billion people, that's a huge amount of potential users that the likes of Pinduoduo can attract to the platform as new revenue in the future. Now, couple this with the fact that the majority of those users who haven't got access to the internet are these rural consumers in the tier 3, tier 4 cities. Now, we know that Pinduoduo is the company that attracts these consumers more than the likes of JD and Alibaba. JD and Alibaba's marketplaces are more set up for the bigger cities, the tier 1, tier 2 cities, whereas Pinduoduo's business model is really set up for those rural consumers that are more price sensitive. So that's definitely an area of the market that they can exploit, and I think this will lead to them eating away market share. Now, the only thing left to do is run a quick valuation on PDD stock, its financials, run a forecast, and see if we can calculate a fair value range for the stock price today. Now, you can see my forecast period here, and all I want to say first of all is that doing a DCF for a company like this is very difficult, and a lot of the time your forecast or inputs are going to be wrong. For instance, here on the top line, I've gone with 30% as a compound annual growth rate, but we know they've already achieved this number in the trailing 12 months. It would probably be somewhere in the region of 70 to 100% growth in 2021, but what we're saying is that it's going to average out around 30%, and at the end of the period they may reach something like 125 billion in revenue, which is the magic number I've put here on Judgment Day for them. The issue is that we don't know when they're going to be profitable. At the moment, we haven't really worked out how they're going to be profitable. We don't know how consumers will react when they have to stop subsidizing a lot of the product. But what we can look at is some relative examples with their competition. So for instance, Alibaba, JD.com, eBay and Amazon, I've pulled all of their EBIT margins here. I'd say the ones that are most relevant are Alibaba and eBay, as well as Amazon, because these guys operate a third-party seller marketplace platform, where JD.com is primarily driven by their first-party platform and logistics service. That doesn't really concur with Pinduoduo's business model, so I've averaged out eBay, Alibaba and Amazon to give us what could be a theoretical EBIT margin on Judgment Day for Pinduoduo. So we've gone with 15%, and then the revenue number, 125 billion. The reason why I've put that there, I just want to give you my thought process behind that. I've taken the retail e-commerce market at the moment, $2.3 trillion US dollars in revenue. The 2030 estimate is around $6.9 trillion in revenue. And if we say it's actually a 40% capture, so I'm being very bullish here for Pinduoduo, 40% capture of that consumer market, then that will be around 2.7 trillion in GMV. And if we convert that at 4.5%, their current conversion is only 3.5 to 4%. But if we say they can get to 4.5%, start to monetize the platform a bit better, then we get to around 124 billion in revenue. So that's sort of my thesis. Look, there's a lot of variables to this, as there always is, especially with a 10-year valuation model. But all we're trying to do here is screen the stock to see if it's near a fair value or if it's very much overvalued, and if we need to put a price target on it for when it does drop and if we want to buy the stock. So last thing we want to look at quickly is the multiple, and I've gone with 25 times. Thesis for that, really, I mean, 25 times is quite basic, but if we look at some of the relative valuations as well for some comparable companies, we've got Alibaba at 22 currently, beaten down stock. JD.com's at around 25 to 30 if you normalize the earnings. Again, though, it's a bit of a beaten up stock, and then we've got Amazon sky high at 52. If we average those out, it's around 33. But I don't have much comfort putting a 33 times multiple on a company in 10 years' time. That's just not something I'd look at doing. So I brought it down to 25 times, which is a bit more normal. But just showing you that I am being fairly conservative with that market multiple if you account for what the relative valuations are. Now, at the moment of truth in the DCF, unfortunately, this does mean if we account for all of those cash flows, remember we haven't got any cash flows in the first 5 years, because I don't think they're going to be profitable until 2025. If they are, then I guess we have some upside, but it's not going to matter much. The main factor here is that market multiple or terminal value. But if we account for all of that, then the intrinsic value for the company today, based off of my 15% required rate of return, is 112 billion as an enterprise, and then a share price of $90 per share at the current shares outstanding. Unfortunately, we're a bit higher than that, $120 per share and 144 billion as a market cap. So currently 25 to 26% overvalued, unfortunately. But if we look at the stock, and this obviously isn't good news for maybe people who own it already, but of course I could be wrong. But if you don't own the stock already and you're interested in this business, its business model, or maybe want to get into it, we have seen a downward trend in the past 3 to 4 months, dropped 37% from its high. We may see it drop further, although the price that we need to get would mean it needs around a 50% drop from its high. Whether that will happen, whether we will see that, I don't know. And of course, there is the possibility that I'm wrong. But for those of you who don't know my way of investing, I like to be able to look at a forecast and model, put in a fairly conservative forecast relative to what the company's doing at the moment and what its growth prospects are. Maybe it's a addressable market. Keep as conservative as possible, and if we can still come up with a fair value based off of that, well, it's probably a good investment opportunity. This one, unfortunately, is just priced a little bit too high for us to be able to do that, even with the impressive growth that they're seeing at the moment. And that will be about it for this video, guys. Hopefully you all enjoyed it. I had a few requests to do this stock, so let me know in the comments below what other stocks you would like to see covered. But I will leave a link to this valuation model on the Patreon page, so go and check that out if you haven't already. See what sort of benefits are over there on the Patreon, and if you're interested in supporting the channel more than you already do. I'd also appreciate if you can leave a like. That helps the channel out, helps the video out. Subscribe to the channel also if you haven't done already, and I will see you all in the next video. Good luck with all of your investments.